The statistical data has an agenda, you should be particularly cautious. The agenda of most people in the financial services industry is to generate fees and commissions. They do so by encouraging you to trade or to purchase products, especially ones that pay them higher commission than others, like variable annuities. They are adept at providing data that appears to support the wisdom of whatever they are selling. It is in this situation that the information provided is often misleading. Relying on it without scrutiny can be harmful to your financial health. Here's a compelling example. You probably own stocks, or mutual funds that own stocks. In order to encourage you to dump your stocks and buy bonds, thereby incurring trading costs, the securities industry and the financial media use data to instill fear and anxiety. They want you to take action. They have a lot of weapons in their arsenal to achieve their goals. One of the most potent and misleading ones is the reference to the lost decade for stock returns. The argument goes like this. The S&P 500 index was basically flat for the past 10 years. Investments in stocks generated no returns for this decade. Why should you continue to invest in stocks, given this dismal track record? The call to action is unmistakable. Dump your stocks and buy bonds. The Wall Street Journal noted that, adjusted for inflation and dividends, the return on the S&P 500 was negative for the decade that ended on June 30th of 2008. Business Week piled on, calling it a decade of decay. The problem with setting forth data in this manner is that it is fundamentally misleading. The S&P 500 index is not an appropriate benchmark from which to measure the returns of a globally diversified portfolio of stocks. It represents only 80% of the U.S. market. It includes many mid- and small-cap stocks. It does not include any international stocks, which should be part of your portfolio. The S&P 500 also does not include any fixed income component,